I've been trading the Forex markets for over 5 years at this point and secured multiple six figures in profits in just the last couple years. Trading has allowed me to quit my job while giving me a better quality of life. I'm able to travel, I'm able to go out when I want and take a day off whenever. So it's bought me freedom. None of that though is even possible without having an actual approach to the market, which I apply every single time I'm trading. If you were to construct a trading strategy from the ground up to be the best possible strategy to make money consistently in the markets, you would want it to be simple and replicable so you can do it again and again. And of course, as effective as possible. This has been my life's work since I started trading back in 2020, but especially in the past 2 to 3 years, once I had the experience required to even make a strategy like this. I consider it to be one of the best strategies in the world, and this is precisely what I'm using to take me to my goal of hitting 7 figures. The strategy is called Ride the Wave, and by the end of this video, you have enough understanding of it to go out and trade it for yourself. So there are a couple of key terms you'll need to know beforehand just so you fully understand what I'll be teaching you. All right, so the first term you need to understand is market structure. This one thankfully is very easy to understand. Market structure consists of higher lows and higher highs of price if we're in a bullish trend, and if we're in a bearish trend, it's lower lows and lower highs. So you know how if you were to switch the chart into a line chart, now you can only see the tops and the bottoms of the market. That's what I refer to when I say a higher low and a higher high. Now, what makes it higher is the fact that the next one is gonna be higher than the previous low. And the next major high is going to be higher than the last. Basically using this, that's how you're able to identify market structure. If it's your first time doing it, you can switch to the line chart, which will literally just point it out to you right away. So for example, right here, if you look at the chart, you can see that the market is going down. So if it's going down, we can literally circle each point where the market makes a high and a low. Every single high that it makes is lower than the previous one. Especially we're looking at the significant highs, the ones where the market stretched out a lot and then came down, stretched out, came down, came down. You know, it's trying to go up, but it's not able to. Those are the highs. And each single one is lower than the previous one. That makes this a bearish trend until at one point, the market stops forming lower highs and does this. This right here is what we consider to be a higher high. So once you have a higher high, it doesn't automatically mean you're bullish because you still have a lower low. So this is conflicting. So all you have to do is wait for it to not be conflicting and for it to actually show you a clear direction. Then up here, we have our first higher low. And then we have a higher high. So now we're more bullish than we were bearish. That's how the trend changes. And that's how you can spot market structure very easily. So the next key term you need to know is trend. In order to find the trend of the market, all you simply have to do is identify where is the market going consistently. So in this case, for example, let's only take a look at what I'm circling here or what I'm boxing off in orange. So as you see, consistently, the market is going lower and lower and lower and lower, and each low is lower than the previous one. Each high is lower than the previous high. Just look at what's inside of this box. That ties in perfectly with the first term, which was market structure. And that's why I taught you market structure first. So that's trend and market structure. So the next term you need to know, and just overall, like it's good to know this, is the moving average. So I use the exponential moving average. I'm going to show you the settings here so you guys can use them as well. And it's on the 50. And this moving average gives us an idea of the second term, which was the trend. It doesn't give us any type of market structure information. It only gives us information on the trend. Now the trend, we should be able to know how to spot it without using the moving average and without relying on the moving average. So that way, you know, we're not overly reliant on an indicator, but it is a good confluence that shows us an objective trend that's happening in the market. But remember, without the moving average, you can still find a trend using market structure, which was the first term that I taught you. The next term is time frame alignment. This one's very simple. Time frame alignment simply means seeing the same thing on multiple time frames. And you're not always gonna see the same type of market structure, but as long as you see multiple time frames with the same trend, let's say it's bullish overall, that is time frame alignment. It doesn't have to be the exact market structure. It just has to show you the same direction. So in this case, if we look at the weekly, we'll see somewhat of a bearish weekly, but recently we have been bullish in the past 4 weeks. If we look at the daily, we'll see that recently we have been on a bullish daily trend. And if we look at the 4-hour, we'll see that we also, once we zoom out, we also have a clear bullish trend established here in this market. So that's time frame alignment. We just got 3 time frames to align. Ideally, you're getting at least 3. And the last term that you need to know for this video, which is gonna help you out a lot, is support and resistance. You guys have probably heard of support and resistance. It's the same thing as supply and demand, the same thing as order blocks. It's the same thing as all of those type of terms. Support and resistance is the original term, and this is actually what it is. If you want to use those complicated terms like supply and demand, sure, but it's the same thing. Support and resistance, we're going to look, where is price rejecting? Price is rejecting here, price is rejecting here. You're looking for multiple taps of the same price. Right here, I see another resistance because price has rejected it multiple times. So that's how you find your support and resistance. We're gonna use this for our strategy a lot, and this is one of the main key concepts that we use to enter our trades as well. So for example, let's look at this one right here. I'm gonna change the color of it. Let's look at this blue zone that I have here. Price came up to it, which is around price of 92.0, and they rejected it right away. It came back up one more time, and if I zoom in, that'll be more clear. So as you see, price came up here, rejected it, came back up, tried to break above this resistance one more time, but it was not able to. Once it does that, it comes down into an area of support that used to be held as resistance. And this is not a coincidence. So the fact that the market comes down into a support area, so it finds support at what used to be a resistance, that is not a coincidence. That's exactly how the market works. And we're gonna use that here in this case to buy and to have a good winning trade off of this zone. So once price finally breaks above this resistance, notice how it comes right back down into our area of support that used to be a resistance. Now it holds it and goes bullish off of here. That's exactly what we're gonna be using. And if you notice, it also rejected off of the moving average. So now you guys are clear with all of the key terms, and now we can actually get into the strategy. All right, let's get started. So we're gonna start off by doing a top-down analysis, starting from the weekly time frame. So if you see up here, I have the weekly time frame selected, the W. So this is where we're gonna start. This is our largest time frame because each candle is an entire week of price action. So simply what I'm looking for here is what's been happening more recently. While yes, it is somewhat important that in the past 2 to 4 months, we've been going down, I mostly care about what's been happening in this past month. Because at the end of the day, yeah, if there is something that happened 5 years ago, we're not gonna use that for our trading. We're gonna use what's happening now for our trading. So on the weekly time frame, be careful not to zoom out too much like this, because now you're literally seeing a whole decade of price action, because each candle is an entire week. So I would zoom in a lot on the weekly time frame, and I would just try to see what's been happening recently, specifically what's been happening in the past 4 weeks. In this case, it's actually perfect because in the past 4 weeks, we've only been going bullish. This is what I'm gonna use for our direction. So following the top-down analysis, now we're gonna go down into the daily time frame. Going down into the daily time frame, we'll see once again, we don't wanna zoom out too far because then we're seeing months and months and months of price action. But more specifically, what's been happening recently? Well, ever since we formed this low in the market down at 86, price has only gone up from there. It's been going consistently higher and higher and higher, forming higher lows and higher highs. So therefore, I'm gonna write that the daily time frame is also bullish. The purpose of writing it down is because we're trying to get time frame alignment, which is one of the key terms. We're trying to get all of our time frames aligned. We're gonna go down into the 4-hour time frame now and just make sure that the 4-hour shows us the same type of trend that we saw on the other 2 higher time frames. So we're going from top to bottom. We're starting at the highest and we're going to the lowest. So here in this case, I see a clear bullish trend on the 4-hour time frame. I see that price is trading above the moving average, and I also see that the moving average is pointing upwards. So whenever you're in doubt, look at your time frame and see where is the moving average pointing to on your preferred entry time frame, which in this case it's the 4-hour time frame. And if it's pointing or slanting upwards, then that's a good sign that the trend is bullish. So we have the 4-hour aligned with the other ones. What you see here is now you start to see a lot more detail, and now you can start to mark off a lot of these support and resistance zones. But we're gonna save that for the next step. Okay, so we have those 3 time frames in alignment. We're gonna go down into the 1 hour just to check and just to make sure, but this is not one of our main time frames. And plus we already have 3 time frames. So that's gonna be pretty much it for now. On the 1 hour time frame, if we look at what's been happening recently, we'll see that overall we are still bullish. So we have here, as you see, higher lows being formed, and this new high that just happened is higher than this one. So therefore, price is continuing to go bullish with these higher lows and higher highs. Look how strongly the moving average is slanting upwards. All of these are signs of a bullish trend on the 1 hour time frame. So now we have time frame alignment. This is a bullish market. So what's the next step now? Once the top down analysis is complete, we start marking support and resistance. I'm gonna take this off. We know it's a bullish market. Now I like to mark my support and resistance. Remember, this is a swing trading strategy. So I like to mark my support and resistance mostly either on the daily time frame or on the 4 hour time frame. So daily and 4 hour. Now in this case, I do see a daily resistance right around here. I see somewhat of a daily support, but I want to confirm that these are the right zones going down into more detail. So if I go into more detail, I'll see that I was close on the 4 hour support, but I'm just going to move it down a little bit to be more precise, to be pinpoint accurate. On the resistance, I can move it down just slightly, but more or less that's the accurate area of resistance. So these are the 2 most relevant support and resistance areas. I wouldn't recommend for you to go back and start marking every single zone on your chart, because then that's going to clutter your chart. It's going to make everything a whole lot more confusing, and it literally provides no benefit to you to start going in the past and marking off zones that are just way too far away from current price action. So I wouldn't recommend you to do this. I know a lot of new traders can get caught up just marking zones just to mark them. I personally only like to mark like 1 or 2 zones, sometimes 3, that are the most relevant to current price action. And that's exactly what I've done here. So we have 93.5 and 92.100. Zones are not price levels. So it's just more or less around this price level, give or take some pips, depending on what time frame, and how big the zone is. In this case, we're looking at a 20 pips zone. And at this 20 pip zone, we know price is likely to reject off of there and bounce off of there. Our next step is literally critical. Without this, you're not going to have a good understanding of what's happening in the market. We're now going to mark our market structure. Specifically, we're going to be marking our higher lows and higher highs. We're going to start off with the lowest and the first major low, which changed the entire market structure. So this is what I call a shift of market structure. This that I have squared off here in blue, this is the shift of the market structure, because we went from a bearish market to a bullish market. Now, what's most important here is just to circle your higher lows and your higher highs, because this is how we're forming our bias of the market structure, which is one of the key fundamental parts of this strategy. We're gonna mark our high up here. This is another higher high. This is another higher low. A good tip for marking them, if you're not sure which one to put the one that stretches out the most. So for example, notice how far price stretched down into here before going up, kind of like it's an elastic rubber band trying to go down, but then it just bounces right back up. The points that stick out the furthest, those are gonna be your best points to mark. Same thing with the upside. That's how we mark our highs. So I'm gonna mark our high up here, very simple, and our nearest higher low, which is this one. So now that we have our market structure marked up and all of our highs and lows marked in the market, we can see what's going on with a lot more clarity. We can see that the market here, there was no higher high, by the way. It's not always going to be perfect, because the market, it's bound to have mistakes. It's not going to be perfect all the time, but overall it still made a high equal to this high, which is close enough. Then we have this higher low, higher high, higher low, and higher low. And even this is still a pretty clean market structure. It's not always going to be this clean. So you really have to train your eye to spot market structure. But once you have your market structure, it's going to make the rest of trading so much easier. You're never going to hesitate. You're never going to have to guess what direction to trade, and you're never going to have to guess where to enter, because with this strategy, we're going to be entering in off of a higher low. If you enter on a higher low on a bullish market structure, it's literally impossible for you to lose, and you get the best possible risk to reward ratio. Because think about it. Let's say you enter in here, you have a pretty tight stop loss, and you have a massive distance until the next higher high. That's why understanding and actually like being in tune with the market and where the lows and highs are being formed, that's the key to this whole strategy. So that's why you got to train yourself to spot this right here that I have drawn up. So now that we have that circled up, we can move on to the next step. Even if you do all of that perfectly, you still need to have a good entry confirmation, because if not, you can mess up the whole thing and you're going to enter in at the wrong place and you're going to lose a trade. So the entry confirmation is how you actually enter the trade, and it's what confirms to us that it's the right time to enter. This also removes hesitation from your trading. What I like doing personally for my entry confirmations is I wait for price to come into a support if I'm buying or into a resistance if I'm selling. Every single time it needs to do that. It needs to have an area that has been rejected in the past, for sure. An extra confluence just means an extra additional benefit that increases the chances of us winning, is that if the moving average is there and it's acting as kind of a dynamic support and resistance, so it rejects off of the moving average, which is exactly what happened here in this case. So this is where our entry confirmation is going to be, but we're actually going to zoom in into the 1 hour time frame to see if we could get some candlestick confirmations as well. So here, for example, we see that the first time price came down here, it rejected right off of there. And then if you were ready to take the buy, then you would have entered in off of this candle, which would have given you a perfect entry. But let's say you were a little bit hesitant to take the trade, then you're going to wait for the market to form a bullish engulfing candlestick just like it did right here, and then you enter in off of the close of that. Now, me personally, I would place a buy limit slightly below the candle, so that way I just get activated later on. In this case, I would have gotten activated around here. But let's just say, to play it safe, you wanted to enter in up here, you still have an amazing trade because you place your stop loss a couple of pips below the zone, and now you can place your take profit at where you believe the next higher high is going to be. And no, this is not the next higher high, because if price comes here like it did, this is not a higher high. This is just an equal high relative to this one. So if this is a bullish structure, which it is because we already analyzed it when we zoomed out and we did our last step, which was marking our lows and our highs based on market structure. And so if it's a bullish market and there is no signs that it's going to reverse, which there isn't at all right now, then it definitely has to continue to go bullish above this zone. So our take profit doesn't go here. It actually goes well above there, where the next higher high is going to be. Now, you can't predict exactly where it's going to be, but you know more or less by zooming out and seeing the size and the magnitude of the previous movements, you can estimate where the next higher high is going to be. For me, I would have it right here. Right here is probably where price is going to go. And this is in real time. You guys can probably check this pair once you watch this video, if you watch it in a couple of days. And most likely AUD/JPY is going to continue up to this price because it's simple market structure. It's by definition. It's how the market moves. So that's why I'm saying, that's why this is such a powerful strategy that I'm teaching you guys here, because if you just implement this, I can guarantee your win rate is going to skyrocket. Stop loss placement, very simple. So where we're going to place our stop loss is below the area of support. The reason why we do that is because if you place your stop loss at the area of support, then price can come down, tap into the support one more time, almost like it did here. It almost tapped into it here and stop you out. And then if you get stopped out on that, then there's no reason why you just got stopped out. There's no reason to place your stop loss there because the market can still continue to go bullish. You want to place your stop loss in a place where if it breaks it and if it hits your stop loss, then it wasn't even a good trade to take in the first place, because it means the market structure is starting to shift. Now that's rarely gonna happen if you follow every single step that I laid out in this video, but once it does happen, you know that you want to be out of that trade. So it's actually a good thing that you got stopped out there and you didn't keep holding, because likely the trend is gonna reverse. So that's why you place your stop loss a couple of pips. It depends on the market. So don't ask me in the comments exactly how many pips below the support. I don't know. It depends on the structure, because on one pair it could be 20, on one pair it could be 30 pips below the support. It depends, but for sure make it at least a couple of pips below support. Take profit placement, like I explained, is going to be at the next higher high point. You don't know exactly where it's gonna be, but just so you know, you can adjust how aggressive you wanna be. If you wanna be super aggressive, then you have a huge take profit. If you don't, and you wanna play it safe, then all you simply do is you place it slightly above the previous higher high, because you know the market's gonna continue and it's going to break this high. The market loves to break highs, especially in a bullish structure like this. It's definitely gonna break above here. So if you place your take profit close to this high, then it's gonna immediately take you out of profit, which is a good thing. But I personally like to extract more money out of my trades, and I would place it up here. I would place it up here because I know the market's most likely gonna come up here, especially the way that the market has been trending to the upside. Okay, so something here is trade management. Once the trade breaks above the previous higher high, and just to be extra clear and make sure everyone's understanding this, it's this high right here. The second that the market breaks above the price where this high was, which in this case is 93.574, I move my stop loss to break even. And that's part of the strategy. So it's trade management. This is how we're going to protect our downside risk, because if the market continues to go bullish, it breaks above here, continues in a bullish trend, but for some reason our take profit doesn't get hit, then at that point, if the market completely reverses all the way back to your entry point, which is a long distance away, then trust me, you don't want to be in that trade anymore, because it's likely to actually be a market structure shift and it's going to start going down. This is exactly the reason why you're going to place your stop loss to break even the second that the previous higher high gets broken if you're buying. Remember, if you're selling, it's the exact same thing. If you had a lower low, the second that your sell position breaks that previous lower low, you place your stop loss to break even. I'm going to press Alt-I on this chart right now, and it's going to invert the chart. So now that I have the chart inverted, this is a sell position. Just imagine it as a theoretical sell position. So you guys can actually visualize what it would look like on a sell. You're selling, you're in profit, the market is here at a support. The second that price breaks it and actually breaks below this lower low, because we are selling in this bearish imaginary trend, that's where you would place your stop loss to break even. Break even, by the way, just means you place your stop loss at your entry point. So that way, if the market goes up, you don't lose any money. It's perfect. It's the best way I found to reduce risk off the table once you're in a successful trade, because you never know, market can have some news, there can be some unexpected movement. You never know what can happen. So just place your stop loss to break even once this does happen. Something else that's critical to understand about this is the trade frequency, because since A+ quality trades won't appear every single day, you may just be looking to take 1 or 2 trades a week, but it wins so much that it's worth it. And because the strategy is so effective and accurate, you can afford to risk much more than if it was a smaller time frame trade or a lower quality of a strategy. So you can definitely risk more than 2% with Ride the Wave. Now, if you listen to one part of the video, let it be this one right here, because this is essential. The more that you trade this strategy, the more you're going to get used to seeing these patterns in the market. And it's just going to get easier and easier with experience. If you want to speed up the process and just get straight to having winning trades every single week, check out synergytradinghub.com. I help traders do that as fast as possible. It's also linked in the description, and you guys get to leverage my 5 years of experience to just get there a whole lot faster. You can become profitable with all of my free resources, so you definitely don't have to spend any money from me or from anyone in order to learn this skill set. However, if you do want to speed up the process, you know where to go.